All right, today we're going to talk about a few different items, such as talking about debt versus equity. Also, what is a convertible note? A promissory note, how does it convert? How you can actually use the funds for your startup business or real estate venture? What is a security? And how do we make sure that you're minimizing your regulatory, your civil or criminal risks? How you can use the funding, and finally, we'll talk about what is a contingent offering. All right, and to start with, let's just reflect a little bit on debt and equity. What does debt mean? It means that you're borrowing money. It doesn't matter if it's from a bank, from a private lender, meaning your mom, your dad, your brother, your sister, or Joe down the street. Borrowing money that they're not taking ownership is a debt. Also, accounts payable. Even if you have a vendor that you owe money to, it's a liability. It's a debt that you owe to this vendor. It's a little bit different than what we're talking about today with the promissory notes, but it's an important concept to take into account. Equity, on the other hand, it means ownership. It's pretty much as straightforward as that. However, it can be structured in different ways where maybe your ownership, you have certain profit rights or voting rights that are different from other ownership structures. But no matter what, at the end of the day, what we're talking about here with a convertible promissory note is somebody that comes in as a debt holder on your balance sheet as well as in your capital stack as a debt holder, but they maintain a right that they can transition, they can convert into ownership at a later time. And so that we just kind of touch on very lightly the accounting behind this. When you look at a balance sheet is a part of financial statements that oftentimes your bookkeeper or your CPA may be preparing for your business. The balance sheet tells you what you own and what your liabilities are in a set moment of time. And assets minus liabilities equals owner's equity, basically equity. Just to kind of explain this, assets are things that you own. Liabilities are things that you owe to others. You take the positive of the assets, you minus out your liabilities, which includes debt, and that equals how much equity there actually is in your business or real estate opportunity. So that's just kind of more of an accounting or a finance analysis of how it affects your books and records. But with a convertible note, and to use this assets minus liabilities equals equity, the debt holder, the convertible debt lender, starts off in the liabilities category. And once they convert, it subtracts out of the liabilities and becomes equity. So you can see how just doing the conversion actually affects the books and records and accounting of your startup business. Really important stuff to know if you're talking to other investors, other finance partners, or ultimately if you're working with any banks or institutions to pay for your business. Really important subject to take into account. When it comes to these debts, it comes down to, and I guess I already just kind of covered this, but who holds debts? You've got the banks, the vendors, private lenders. And this is where the convertible notes come into play, because generally it's not a bank that's taking an ownership. It's not a vendor that is taking ownership of a debt. It is generally a private lender that is agreeing to make you a loan. They hold and have a right to this promissory note, and they have a right to convert to this equity. Well, why would they do this? Why do banks like having debts versus equity? There's a priority interest in a company based on debt versus equity. When it comes to your normal business operations, oftentimes you got to pay your credit card bill. And your credit card bill is a debt. And if you don't pay that bill and the credit card company has to take action to try to sue your company or try to foreclose on the assets of the company, they get paid off in full before any of the equity investors, before any owners receive anything. So that's where we call it a priority position of debt over equity holders. Now we're going to go a lot deeper into note documentation. If you click down below, you actually have a form that you will be able to follow along with. But just to kind of touch on what other types of debts there are, we're talking about promissory notes. Now, to really confuse things, oftentimes there's a loan agreement that discusses a lot of the same topics as a promissory note, but here's where it tends to be a little bit different. With a promissory note, it's usually just a few page document that hits the highlights of when does the loan mature, when are payments being made, what happens if things default. Very straightforward, where the loan agreements may actually deal with other but similar concepts, such as, is there a disbursement schedule? Are there requirements on providing to the lenders certain reports, whether it's annual tax returns, whether it's personal financial statements, whether it's banking statements? Those type of additional requirements often come down to a loan agreement. For what we're going to talk about here, we have a quasi-loan agreement, but we're going to call it a purchase agreement. And I'll explain why when we start digging into the documents themselves. Now, everybody's always heard about bonds, and I just want to impress upon you that actually a bond is the same thing as a promissory note, just called something a little bit differently, and really it's kind of a default securities offering that corporations, larger corporations, will tend to use, and it has certain bondholder rights. In the event of any liquidations or bankruptcies, they're always secured. To compare that to something else that's called a debenture, it's actually one of these companies that are raising non-secured, unsecured loans from investors. It's actually still the same thing as a promissory note, a bond, a debenture, just with the major difference of that priority. Bonds secured, it has priority over debentures, unsecured. And then finally, the accounts payable, that just may be based on a purchase agreement or other types of invoices that have repayment terms that you've seen it. You've seen it in your credit card bill. If you don't pay by this date, we're going to tack on so much percent interest. That's an account payable, and it's another form of debt. So when we talk about, how do you actually use the funds and why would you even do this? Let's just clear the plate for a minute and put you in, you're starting a business. You have a business plan, you have a dream and a goal, but you don't have the money to actually pay for the organizational costs, meaning setting up a company, getting funding from a bank, hiring the prototype developers, or in real estate, paying earnest money deposit, or paying for the inspections of properties that often cost thousands of dollars. If you're doing a construction development, paying for architects, engineers, dealing with the city. And I can tell you, all that's expensive, and oftentimes, all of that is taking place before you're receiving financing from a traditional bank or seeking funds from private investors. The reason why it tends to be kind of used for initial expenses is, unlike raising capital from 20, 50, 100 different investors, generally you're getting one lender. And I'll explain why in a little bit. So it's usually a smaller amount that is there to help you get to that starting line, help you get to that next step of being able to launch your business or real estate opportunity. I'll explain how we use it with our clients all the time. It costs something to put together an investment offering, to pay for marketing, to pay for graphic design, to set up the entities. It just costs money. And you know what? If you come to me and say, I don't have any money, I have this amazing idea, I'm going to be a unicorn, industry changing, I don't have the money to get started. And you know what? Not many people work for a dream. Not many people can. You gotta keep lights on. I use this strategy and this concept all the time with our clients, saying, I've got a strategy for you. Here's this convertible note. Go out and find that one lender that believes in your dream. Doesn't matter if it's your mom, grandma, friend down the street. As long as there's only one, for the reasons I'll talk about later, they can contribute to help you get started with your business. From a perspective of an investor, they can have a priority position, meaning that if things don't work out, they have a right and ownership to any of the assets that apply to the business, even if it doesn't end up being successful. So that's something to take into account as you're saying, well, how am I actually going to use this? And why I say, why would the lenders want to do this for you? Why would your family want to do this for you? They're coming in a priority position, meaning if it doesn't work out, they have a right to collect on the borrower. And if things work out wonderfully, no problem. They get to take an equity and ownership position in your business. So it's really a win-win for them, as well as for yourself. If you don't have the money to get started, this is an easy way to get started. And also something that I tell all our clients that are thinking about doing an investment offering. Hey, if you can't get one person to believe in your business and believe in your plan, don't waste your money trying to get everything set up to do a full investment offering, because that's going to require the same sale to 20 more additional people. That you always learn to walk before you run. So you start with one, and you start with these convertible notes. If you'd like to learn more, click below to join the entire class and program to not only learn about these convertible notes, but also get your own already set up form so that you can get moving forward with your business.